Steve, is this bull run going to continue?
Yeah, I think in the medium and long term, it does. We're exiting recession. We're entering recovery. And so far, even though the virus data has picked up, which is quite worrisome, the measures that have been put in place, the re-shutdowns have been very targeted. It's the restaurant industry or bars. It's not some kind of blanket re-shutdown. And that's allowed the economic data to continue to be pretty good. And so there's this tug of war between the better virus data and the worse virus data and the better economic data. And so far, the economic data is winning.
But that kind of flies in the face of all of this stuff that we say that the chief concern, Steve, is the virus stuff. We've been saying it for weeks now. Experts have been saying it. Why are we shrugging that off and favoring some of the backward-looking economic data?
Yeah, your guess is as good as mine on that one. I think what it really comes down to is the virus data is the key concern for the market if it threatens the reopening and if it threatens the economic recovery that's coming from that opening. So far, one of the phenomenon that we're seeing across the southern and western regions is that death rates have been lower because there's a younger population that's contracting the virus. And so in that environment, states have so far been able to, again, shut down in a more targeted way. And when they do that, the bulk of the economy is still able to operate. Now, you do have to watch some of the high frequency data. There's things like restaurant bookings and some retail activity that are starting to show some softness. If that feeds into more traditional data like retail sales and hiring, then you've got a problem. If it doesn't, if you're able to try to put some of these measures in place to contain the virus and it doesn't cause, a large scale shutdown, then I think the markets can live with the virus, which isn't something we thought it could do a month or two ago.
We've been showing a series of charts, Steve. I'm not sure if you can see them on your end here, but basically all the parts of the market that have been surging since the COVID lows back in March. This notion right now, the trend is your friend, perhaps, is upside is favorable. But it sounds like the uncertainty makes us all want to be in cash 100%. What exactly are you doing as a portfolio manager?
Yeah, the way we think about this is if you didn't have a surge in cases, I know that that's not the world we live in, but if you didn't, this would be a maximum bullish moment. You'd be exiting recession, entering recovery, a lot of slack in the economy, a lot of slack in the labor force. That's what you really want to buy. So we're tilted towards being overweight stocks. However, we have to temper that because I do have a pickup in virus cases. And so, we find ourselves modestly overweight stocks, a couple, 2-3% over our neutral points. We like growth because it's been defensive and we think we've got good cash flows there. And when we feel a little bit better about things, we dip into value. When we feel a little bit more conservative, we shy away from the cyclical value because that needs economic growth. And that's going to be a function of how well this reopening goes.
We've just got about 15, 20 seconds here. What parts of the market do you like and what do you stay away from?
We like small caps here. We do like growth. We think that's a safe place to be. We increasingly like international just because the virus data is a little bit better there and there seems to be a little bit more fiscal cohesion. What we're staying away from is those real deep cyclicals right here. We think there's going to be a little bit of choppiness in the next couple of weeks and months here.